you guys for attending today's class on CalHFA's programs. We are going to give about a few minutes. I'm going to put in my information on the chat. So if you guys have any questions, we were going to address them after the webinar, but it's 5:57 now. So we're going to give it about another 5 to 7 minutes before we start the presentation. So thank you for joining us. Good evening, everyone. We're going to get started in a few minutes. So just checking my mic. Can you guys just in a chat let me know if you could hear me properly? Awesome. Thank you. All right. Thank you guys for joining us this evening. It's 6 o'clock. Thank you guys for tuning in on a Tuesday evening. We appreciate every single one of you. And today we have a very special guest, Leanne Walker from CalHFA will be presenting the programs that they have to offer with down payment assistance. So, hi, Leanne. Thanks for joining us. So my name is Luz Yuncor with New World Mortgage. We are powered by American Pacific Mortgage. Our corporate office is at Roseville, California, and we've been passionate about providing programs for first-time buyers for over 2 decades. Personally, I've been working and hosting workshops with CalHFA for a very long time, and today's presentation will cover the majority of the programs that they have available. And of course, we will cover a little bit about the coming soon Dream for All program as well. And we are going to follow her presentation with just some tips about how to prepare to submit your application for any of the CalHFA programs, along with, just some tips and some of the things that we have learned about the program in the last couple of years. So feel free to please, do any questions on your chat. We'll be more than happy to answer them throughout the presentation. I'll be answering some of them as well, but we're going to try to cover them at the end. So thank you for joining us, Leanne. So go ahead and can you unmute? Perfect.
Yeah.
All right. Well, thank you. Leanne Walker from CalHFA will be doing the presentation. Thank you for joining us today, Leanne.
No problem. Well, let me share my screen.
Yes, so let me see. Let me know if I need to give you permission to share.
Yeah, you need to.
Okay, there we go.
Okay.
Did it work?
Yeah, I think. Can you see my screen?
Let me see, I'll stop sharing mine. Yes,
Okay.
perfect.
All righty. Thank you, Luz.
Of course.
Good evening, everyone. Thank you guys for tuning in on a Tuesday evening to learn about how down payment assistance can help you buy a home. So, CalHFA is a state agency. So, we are the state of California. We were created back in 1975, so we're celebrating 50 years this year. And in our 50 years, we have helped over 233,000 first-time homebuyers be able to buy a home. So we have done a lot of loans, and we, hope to do a lot more. So we know it's expensive here in California. No matter where you are in California, all of California is expensive. So it makes it really hard for you to save up for your down payment because rent is going up, gas, groceries. So money that you may have been saving is now going to your everyday expenses. So that's where we come in and help with our programs. So whether you have some money saved up or no money saved up, you can use our programs to help cover your minimum down payment. Now, since we are a state agency, you don't apply directly through us. The Dream for All is a little bit of an exception, and I'll talk about that. But you have to go through one of our approved lenders. So Luz is one of our approved lenders. She is actually one of our preferred loan officers. And those are loan officers that work for one of our approved lenders that do a lot of our loans. So they have to do so many loans every year to be on that list. So those are the ones we recommend because they do our program every month. So they know how to qualify borrowers and get them into our programs. Now, I'm going to cover a lot of information in a short amount of time, but don't worry, you don't have to remember every single thing I say today. That's what Luz will do for you. So everything goes through the approved lender. They're going to make sure you qualify for the loan, that you meet all the guidelines. My main goal here tonight is to let you know that there is help out there. So if down payment is what's holding you back from buying a home, just know that there are a lot of programs that can help you. So we have 3 programs that we have ongoing that I'm going to talk about first. And then I'll talk about Dream for All at the end. So it's good to know that these are our regular programs and they're available year round. So unlike the Dream for All, that it's an application process, it only comes around every so often. And then we get a certain amount of money. Once the money is gone, the program's gone. So that is not the case for our regular programs that I'm getting ready to cover. They are available year round. So whether you're ready to buy now, 6 months, a year, or even later, just know we're going to have a program that's going to help you. So our main program for down payment is called our My Home program. That's going to cover your minimum down payment. So either 3 or 3.5%. There's 4 standard mortgages out there for the first mortgage. So there's FHA, there's conventional, there's VA, and USDA. Now, the 2 most common are going to be conventional and FHA because VA, you have to be a veteran to use that loan. If anyone on here is a veteran, that is hands down the best loan. And USDA is if you're looking to buy in an eligible rural area, then you can use a USDA loan. So most people are going to fall under FHA or conventional. And that's what the lender's going to do when you apply through them. They're going to look at your situation and figure out which one works best for you. Because everyone's situation is different, and what works for one person may not work for the next person. So FHA is probably the most popular because it is a little bit easier to qualify than conventional. You don't have to have perfect credit to buy a home. You still have to have decent credit, but FHA is going to be a little bit more lenient on the credit than conventional. So again, that's what the lender does. When you apply through them, they're going to look at your whole picture and they'll be able to determine whether FHA or conventional is better for you. Now, if you're doing an FHA loan, FHA requires that you come in with 3.5% down payment. So whatever the sales price of the home is, then you would need to come in with that down payment, 3.5% of that sales price. So our My Home will cover that full 3.5% down payment for you. So you wouldn't need to come in with any money at all for your down payment. So that's what our My Home does for you. So just say you were buying a $600,000 home, 3.5%, that's $21,000. So that you would have to come in with. So our My Home would cover that full $21,000 for you. So whatever the sales price is, 3.5% of that is what FHA requires that you come in with for your down payment. Our My Home will cover that full down payment no matter what it is, whether it's lower or higher, whatever that 3.5% is, My Home will cover that full amount for you. Now, if you're doing conventional requires between 3 to 5% down. And that's when it's going to come down to what your loan amount is. So the lender will be able to determine this once you apply with them. So if 3% is only required down, our My Home will cover that full 3% down for you. Now, if you are buying a more expensive home where your loan amount is going to be a little bit higher, then that's where conventional requires 5% down. Our My Home still only gives 3% on a conventional. So that's the only time My Home doesn't cover your full down payment. So we'll cover 3% and then you would just cover the additional 2%. But in every other case, My Home covers that full down payment for you. Now, if you are a veteran using VA or you're looking to buy in a rural area and going to use USDA, both of those programs don't have a down payment requirement. So you can still use our My Home with those two programs and put it towards your closing costs. So you would get 3%. So My Home is flexible to where it could be used for both down payment and closing costs, wherever you need it. But usually if you're doing FHA or conventional, usually My Home is going to be used for your down payment. Now, if you have saved up some of your own money, you can combine your money with My Home to get a bigger down payment. So My Home will cover the minimum that you are required to bring in, but you can always put a bigger down payment. That could do one of two things. That can increase the sales price you qualify for, or it can help lower what your mortgage payment is. So just know our My Home is flexible to where you can leave your money in the bank and just use our program to cover your minimum, or you can combine your money with our My Home to get that bigger down payment. And again, the lender can run scenarios for you to show you what it looks like, to see, okay, what would it look like if I combine some of my own money? So that's where the lender comes in handy and runs scenarios for you and show you what it looks like. Now, My Home is a loan though, so it's not a grant, it's not free money. You do eventually have to pay this back, but it's silent. So what that means is that there are no monthly payments. And you just pay this back when you either sell the property, refinance, or in 30 years, whichever comes first. Now, our hope is that when anyone buys a home is that you build equity. And our hope is that when it is time for you to pay this loan back, you have built up enough equity in your home to use the equity to pay it back. And that's what happens for a lot of our borrowers. These programs are helping you get your foot in the door now so you can start building that equity. Say in a couple years, the interest rates drop, you now want to refinance, get that lower rate to lower your payment. You would have to pay back My Home at that time. But if you have enough equity, you could just pay it off through the refinance. And that way you're not having to come out of your pocket to pay it back. But if you do refinance too quickly and you haven't built up enough equity, then that's where you would have to come in with your own funds to pay it back, or you can just wait to refinance. You're going to always have several opportunities to refinance. So don't think that as soon as the rates drop, that's going to be your only chance. You're going to have several opportunities to refinance. Average people at least refinance at least 2 to 3 times per house that they're in. So just know you're going to have opportunities. My home does come with a 1% simple interest. So interest is accruing, but only at 1%, which is very low. So say you got 15,000. 1% of 15,000 is $150. So that just means every year $150 will be added to your balance. So you got 15,000, after 1 year you owe 15,150. After 2 years you owe 15,300. But so it'll be the same amount being added each year. Payments are not required, but you can make payments at any time. You can pay this loan off at any time. There's no prepayment penalties. Now, in addition to down payment, you're going to also have to come in what's called closing costs. And that can vary from loan to loan. Average we see is about 3 to 4%. Sometimes it could be less, sometimes it could be more. But that's about the average we see. Now, your best option to get the lowest interest rate with our programs would be just to use our My Home to cover your down payment, and then you cover your own closing costs, or work with your realtor to see if they can get the seller to give you a credit to pay your closing costs. But say you don't have the money to cover your closing costs and the seller's not willing to give you credit, or they're only willing to give you a small credit, then that's when you could look at adding one of our two other programs. So either our ZIP program or our My Access program. So our ZIP program will give you 2 to 3% to help cover your closing costs. So it may not cover all of your closing costs, but it will cover the majority of it. So you combine this with the My Home. So in this case, My Home would cover your down payment. ZIP would cover the majority of your closing costs, leaving you with very little that you have to come in with to buy the home. ZIP is a loan as well, like I mentioned with My Home, that it's due whenever you sell, refinance, or 30 years. But ZIP has zero interest. That's what ZIP stands for, zero interest program. So there's no interest accruing on this. So say you got $10,000, all you owe is $10,000 no matter when you pay it back. But it works the same as My Home to where you pay it back when you sell, refinance, or 30 years, whichever comes first. Now, in addition, we have our My Access program. That's our newest program. It's only been out maybe about 5 months. So you would use this instead of ZIP. So you would still add this to My Home, and My Access gives you 2.5%. And this one you can use for down payment or closing costs, wherever you need it. So ZIP can only go for closing costs. So My Home can go for either one. So like on that conventional loan I mentioned, say 5% is required down. I told you My Home will only give 3%. You would need to come in with that additional 2%. If you didn't have it, that's where you can add on My Access and use 2% of that to cover your down payment. So now you have your full 5% down payment covered. So again, you can use it however you need it. It has the same 1% simple interest as My Home. And again, it's a loan that has to be repaid when you sell, refi, or 30 years. So you can only put two of these together. So you can't put ZIP and My Access together. And don't worry, you don't have to figure out which combinations you're going to use. That's what the lender does for you. So they can run scenarios for you. So we have a calculator on our website that our lenders use, and it lets you do 3 scenarios at a time. And that's what you have, 3 different options with these 3 programs. So to get the lowest interest rate that we offer would be just to use our My Home. And again, you cover your closing costs or see if the seller's willing to give you a credit. Or you could do My Home and ZIP. So if you did need help with your closing costs, again, My Home would cover the down payment. ZIP would cover a good portion of your closing costs. Or instead of ZIP, you could choose to add My Access. Now, when you add ZIP or My Access, it does increase your interest rate on the first mortgage. So that's why the lender's going to first try to see if My Home alone will work for you. And then if not, then that's when they'll look at adding ZIP or My Access, because it is going to increase your interest rate. The more assistance you need, the higher the interest rate's going to be. So they can run all 3 of these scenarios. So My Home by itself, My Home and ZIP, or My Home and My Access. Those are your three options. So they can rent all three of those scenarios and they'll be side by side. That way, that can help you choose which option is going to work best for you. And again, the lender's going to do all of this. So again, you don't have to try to figure out, do I want zip? Do I want my access? The lender does all of that. And they're going to go by what do you need? What's going to work best for your situation? So you have those three options. So My Home by itself, My Home and Zip, or My Home and My Access. So those are going to be your three options to combine those programs. Now, we do have some requirements to get these programs. So you have to get the approval from the lender. So you'll apply through the lender. They're going to make sure you meet FHA guidelines or conventional guidelines, VA, USDA, whichever first mortgage you're using. The first mortgage is done through us as well, so we're offering all those first mortgages, but we allow the lender to do all the credit qualifying. So they're going to make sure, because they have to get automated approval to make sure that it meets FHA or conventional guidelines. Then they're also going to check to make sure you meet our additional guidelines. So in addition to meeting the first mortgage guidelines, you also have to meet the guidelines to get our assistance. So we do have a minimum credit score, 640 for the government loans. So that's FHA, VA, USDA, and then 680 for conventional. Now, if you're looking at that and you're like, oh, my credit score is lower than that, I might as well drop off the call. Don't do that. Luz is really good about working with you. So I always say, no matter what lender you go through, you want to work with the lender who's going to let you know what you need to do. Because if you apply with someone and they say, sorry, you don't qualify, and then they send you on your way, you don't know what you need to do. And so you may wait a year and be like, okay, I'm going to try this again. You apply again, you may go through a different lender, maybe the same lender, and then they're like, sorry, no, you don't qualify. They send you on your way again. Again, not telling you what you need to do, then you're going to get discouraged. And we don't want that. So even if you're not ready now, the whole thing is to get you ready. And that's why you want to work with someone who's going to say, sorry, you don't qualify right now, but here's some steps that you can take. Let's get you on a plan. So whether it's 6 months, a year, 2 years, and Luz will tell you, she's worked with people up to 5 years to get their credit right. So you definitely want to work with someone who's going to work with you, let you know what you need to do. Sometimes they may need to refer you out to someone who specializes in that, but they'll at least let you know what you need to do and follow up with you so that you are ready eventually. Because the goal is for you to eventually buy a house, even if it's not right now. So don't think that on this call today you have to be ready to buy right now. I told you in the beginning, we've been around for 50 years, so we're not going anywhere anytime soon. So we're going to always have a program for you, no matter how long it takes you. So we do require that you are a first-time homebuyer. Now, our definition of a first-time homebuyer is someone who hasn't owned their primary residence in the past 3 years. So it's not just someone who's never owned before. You could have owned before. Long as it's been 3 years since you last owned your primary residence, we still consider you a first-time homebuyer. We also require that you go through homebuyer education. We want to make sure you are educated homebuyers, you understand the home buying process. You have a couple options. You can do online through a company called eHome, or you can do in-person or virtual through any NeighborWorks or any HUD-approved 8-hour course. Now, the lender will help you out with this when you apply with them, because we do recommend that you take this as early as possible in the process. Because once you complete the course, you're going to get a certificate. It's good for 1 year. So we do recommend take it as early as possible. Unless you just are like, oh, I'm probably going to wait at least a year to buy a house, then you can, wait to take it. But if the lender pre-approves you and tells you you're approved and you're going to, eventually start looking for a house, take it then. That way it doesn't hold up your closing. I get calls every week from lenders panicking because they're set to close in a few days, but the borrower didn't complete their homebuyer education. They haven't received their certificate yet. And you're not going to be able to close on your home until you get that certificate. So get it done early. That way you're not waiting till the last minute to get it done. Now, if you choose to do the online, that's the most popular one because it's self-paced. So if you do in person, or a lot of agencies offer on Zoom, like what we're doing tonight, but those are 8-hour courses. So you're having to sit there for the full 8 hours. So a lot of people are like, oh, I want to do the online because you go at your own pace. You could do an hour today, hour tomorrow, hour the next day, because it's self-paced. It's not a live instructor. But there is an additional step when you go that route. After you complete the online portion, it is scheduled for 8 hours, but it just depends on how fast you read and retain the information. I see most people finish it in maybe 6 hours. But again, the benefit is that you don't have to complete it all in one sitting. So you can break it up over days or weeks if you want to. But after you complete that online portion, you do have to schedule a phone appointment with the counselor. And you don't get your certificate until you do that. And so that's the issue that I'm running into with a lot of lenders. They send their borrower there, and the borrower is thinking, oh, it's online, so I can go at my own pace, so I can wait to the last minute to get it done. And then they finish it, and they're like, okay, I'm done. And then they don't realize you have to do that phone consultation. And they get backed up. Sometimes it could take a week or 2 weeks to get an appointment. So if you wait until a couple days before you're set to close on your home, and they could be backed out for 2 weeks. And then now you could risk losing the home just because you didn't get the homebuyer education done. So it's good for 1 year. So that's why I recommend get it done as early as possible. Now, we also require that you get a 1-year home warranty. Now, 9 times out of 10, the seller's going to pay for this for you. It's going to cover your systems and appliances. So different than your homeowner's insurance. Your homeowner's insurance covers the structure of your home. So if your house catches on fire, tree falls on your house. Home warranty covers your systems and appliances. So basically everything inside the property. So it's going to cover your HVAC system. So your heating, your air conditioning. It's going to cover your electrical, your plumbing, your built-in appliances like your stove, your oven. So this kind of ties into the homebuyer education requirement, because if you're renting right now and something breaks, what do? You call your landlord, right? They come and fix it. But when you own the home, you are now your own landlord. You have to get it fixed. So this is why we have this requirement for that you get it for the first year. Because with the homebuyer education, they're also going to go through budgeting. It's very important that you budget when you own a home, because things are going to break. Believe me, I'm going through it right now with my house. It seems like everything just breaks all at once. So this is where a home warranty comes in handy. So it works kind of like an insurance policy where you have a deductible. They call it a service fee, and it can vary based on what plan you get. It could be anywhere from $85 to $150. So what happens if something breaks? So say your plumbing goes out. You call them, they send a plumber out. Plumber fixes the issue. Say the bill would have been $2,000. But you have an $85 service fee. All you pay is $85. You don't have to pay the full $2,000. So again, something else breaks, you call them. They send someone out, fix it. You just pay that same service fee every time you have to have someone come out. So it comes in handy for that first year. After the first year, it's up to you if you want to renew it. Then you'll be responsible for paying for it. Like I said, majority of the time the seller will pay for it, but it's not automatic. They will. Some sellers may refuse to pay for it, and you just have to be prepared to pay for it. But majority of the time, they will pay for it, and this is something you'll work with your realtor, and your lender will work with the realtor. So when you go to put an offer in, then they know that you're doing CalHFA and that we require this, so they'll put that on the contract to see if the seller will pay for it. The budgeting comes in handy because you have to perform maintenance on a home, just like you perform maintenance on your car to prolong it. But things are going to break, and then you have to be responsible for getting it fixed. So that's why the homebuyer education, they also go through budgeting. So you can learn to budget. So if, say, in a couple years you decide you don't want to renew your home warranty, then you're responsible for paying the full bill if something breaks. So we just want you to be prepared. And then you have to be buying a single family 1 unit property, and it has to be owner occupied. So what that means, you are buying this home to live in it. You're not buying it for an investment property. So you are going to buy it and you're going to live in it as your primary residence. So 1 unit, so that means you can't buy multi-units on our program. You can't buy a duplex, a triplex, a 2 to 4 unit, but you can buy a condo, a townhome. We even allow if the property has an ADU, so an accessory unit. We call them different names: granny flats, in-law quarters, guest houses. As long as that appraisal comes back saying it's a 1 unit with one accessory unit, then we are okay with that. We're also okay with manufactured homes, but it has to be a true manufactured home, meaning that the house is permanently affixed to the land and you own the land that it's on. So it can't be like a mobile home in a park. So it's going to be just like a regular stick-built home. When you buy the house, you're buying the land, it's all together. So that's the same with the manufactured home. It's already permanently affixed to the land, just like a regular stick-built property. So you're buying the house and the land all together. And then our last requirement is income. So we do have income limits. Like I mentioned at the beginning, we are geared toward low to moderate income. But our income limits are actually pretty high to be a low to moderate program. Some of you may be listening from all over. I only have Southern Cal up here because usually I do these with Luz in person, and they're usually in Southern Cal, even though I'm actually in Northern Cal. But you can go on our website and get a list of all of the counties. So remember, we are the state of California, so you can buy anywhere in the whole state. I just had listed some of the Southern Cal counties on here, but definitely, long as it's in California, you can use our program. But just give you an idea, if you're buying in LA County, you can make up to $211,000. Riverside, San Bernardino, it's 205. Orange County, 270, and so on. So every county is going to have its own income limit, and it goes by the county that you're purchasing in. So not where you live now, but where you're going to buy, where the house is located. And we only count the income of the purchasing borrower. So we're only counting income of who's buying. We don't look at household income. Some programs will count everyone's income that's living in your house, even if they're not buying. We do not do that. So if two of you are buying together, then both of your incomes combined cannot exceed our limit. If you are buying by yourself, we're only counting your income. And we use the same income that the lender uses to credit qualify you. So as soon as they qualify you, they're going to know right then and there if you meet our income limit or not. So you don't have to worry about that because we go by the lender's qualifying income. So as soon as they qualify you, determine what your qualifying income is. That's the same income that we're going to use for our income limits. Now, Luz, was there before I jump into Dream for All, I like to break it up because there are different guidelines. I just wanted to see, are there any questions I need to answer before we move on?
Yes, hi, Leanne. Yes, absolutely. So here's some questions for the ZIP program. Can it be used ZIP only by itself?
No, you have to combine it with My Home.
Okay. Also, can it be single? They can't afford a single family. Will this program work for townhomes and condominiums?
Yes.
Another question is My Home, ZIP, and My Access separate from Drain for All, or they
Yeah.
can be all used together?
No, they're separate. So you could put My Home and Zip, My Home and My Access together. Dream for All, you can't combine any of those with Dream for All.
Correct. And then what is the maximum debt to income ratio for any of the loans you mentioned?
So it's 45% if you have under a 700 credit score. We will go to a 50 if you have a 700 or higher.
Okay.
The only exception is if you're buying a manufactured home. If you're buying a manufactured home, we will only go to a 45 debt ratio. But
Okay. And
on a single family, townhome, condo, even if it has ADU, it's 45% is the max debt ratio for under 700 credit score, 50 for 700 or higher.
Okay. Another question about home buyer certificate, if it expired.
Yes, 1 year.
Okay. And for that, we have an actual coupon that will give you $50 off. If you're interested in that, we'll email everyone the code to get $50 off from an online HUD class. But it does expire on December 31st, so you have to kind of hurry and take the class. All right, that is it for now.
Okay.
Okay, perfect.
Okay. I like to separate that because Dream for All has different guidelines than our regular programs. So I'm already giving you guys so much information and your heads are priority spinning. So I like to try to separate that to make it a little less confusing. So just know those My Home, My Access, Zip, those are our regular programs that we have year round. We don't run out of money. That's why we have them as loans. They're there to help someone. Then when they go to pay them back, it gets put back into our pot of funds to help another family. So it's recycled funding. So that's why we always have funding available. So My Home and Zip, we've had since 2010. So that just lets you know that we don't typically run out of money with our regular programs because we are actually a self-funded state agency. So those programs come from our own funding. Now, Dream for All is a little bit different. So we do administer the Dream for All, but it's not our funding. It comes from the state budget. So it started from a Senate bill that got passed with the state budget. So this is a program that comes and goes, and it may not always be available every year because it's based on the state budget. So we have to wait every year when the governor does the budget to see if they're going to allocate any funds toward Dream for All. So in 23 was the first year that we received funding. We received 300 million and it went in 11 days because it was first come, first serve. So we had no way of knowing it was going to go that fast. So when we got funding for the second round last year, in 24, we decided to switch it up because there was a lot of people that were interested, ready to buy, but the money went faster than anyone could think. So we changed it up because we wanted it to be fair across the board. So we switched it to drawing. So a lottery, which they keep telling me to stop calling it a lottery. It's a randomized drawing, which is a lottery. It's just that when you hear lottery, you think free money. It's not free money. You do have to pay this back. But it's the process is like a lottery, but it's a randomized drawing. So we didn't get money for this year, but we are getting funding for next year. So we haven't announced any dates yet. We just know it will be early next year. So probably February, March, or April. Doubt it would be January because we try to give our lenders and everyone at least a month notice. So we're looking at probably February, March, or April when it may come out. Again, there's no guarantee. I have no idea. We don't know yet because this is something we have to wait for the state to give us the go ahead. So once we announce the date, then it will have the date that everyone can register. But we wanted to come out early just to let everyone know that it is coming back because there's always a lot of misinformation floating around. Last year was really bad. Luz can tell you. There was all over social media. People were giving out wrong information. People were holding their own seminars and making it seem like it was CalHFA, that one of us was going to be attending and it was not. And they were giving wrong information and they were just trying to get people in the door and then try to switch them to something else. So we wanted to get ahead of that this year. Before people started. It's not as bad as it was last year, but it's already starting. I'm starting to see where people are doing their own seminars, and that's fine, as long as they're giving the right information. And they shouldn't be acting like someone from CalHFA is going to be there if we're not. So I'm directly from CalHFA, so you're in good hands. You're getting it straight from the horse's mouth. So but we don't, like I said, we don't have a date yet, but we wanted to come out early, let everybody know, hey, we did get funding for next year. And so people can start getting ready in case this is a program that may work for you and you can qualify. It may not work. Just like any of our other programs or any program, everyone's situation is different. So what works for one person may not work for the next person. So that's where your lender comes in handy. A good lender is going to be able to figure out what programs you qualify for, whether it's CalHFA or another program, the city or county program. Some of them you cannot put together. Well, majority of them, there may be some you can, but majority you can't put them together. So you have to choose one or the other. So that's what the lender is going to look at your situation, figure out which programs you qualify for, and then break it down to see, okay, which one's going to work best for you. Sometimes CalHFA is going to be the best option. Sometimes it may not be the best option. We want you to buy a home, even if it's not using our program. So we always welcome borrowers. Look at all the programs that you may can qualify for to make sure you're getting the best deal. But again, the lender's going to do all of that for you. So what the Dream for All is, it's a conventional loan only. So another reason why we came out early, because like I mentioned at the beginning, conventional financing is a little bit harder to qualify than the government loans. So this can give you time in case you have some credit issues, then it gives you a little bit of time to try to get them taken care of. Because we don't want you to wait and when we announce it and then you go to apply and then you don't qualify, when you could have had a couple months to where you could have been cleaning it up. And maybe it's something that's not going to take that long. But once it's time to apply, it's a very small window of time that you have to apply. So if you have any credit issues, you want to start working on those now. So hopefully they'll be taken care of by the time we announce the date. So why the Dream for All is so popular is because it gives 20%. So it's giving a lot of money compared to our regular programs. So it gives you 20% that you can use for down payment. And where that is huge is if you put the full 20% for down payment on a conventional loan, when you put 20% down, it avoids the mortgage insurance. So now that's already saving your mortgage payment. So that's going to save you a couple $100 a month on your mortgage payment. So, sorry, I just need to adjust my screen here. And sorry, I don't know why it's so blurry. So sorry. So you could put the full 20% for down payment, and then you would just pay your own closing costs or get help from your seller to see if they'll pay some of your closing costs. But you can split it up. You can use up to 5% to put towards your closing costs. So you could put 5% toward closing costs, the remaining 15% for down payment. So you can do that if you did need some help with your closing costs. You can use up to 5%. Now it's 20% or $150,000, whichever is less. So it's going to be the lower of the two. So what it breaks down to is if you're buying a home for $750,000 or lower, you'll get 20% of that. If you're buying a home over $750,000, then that's when you'll be capped at the $150,000. So say you're buying a home for $500,000. 20% of that is $100,000. So you'll get $100,000, not $150,000. So it's not just an automatic $150,000. So it's 20% of the sales price or appraised value, or $150,000, whichever is lower of the two. So it's giving you a good amount, so that can help increase the sales price of what you qualify for or help lower your payment. But it is a loan, so it's not free money. So that's why I was saying, that's why they keep telling us to stop calling it a lottery. So it's not you're not winning money that you don't have to pay back. You do have to pay this back. So just like our regular programs that I mentioned, like My Home, it's due and payable whenever you sell, refinance, or 30 years, whichever comes first, but it has 0 interest on there. Now, in addition to that, it's also the shared depreciation loan. So this is something we want to make sure you understand, because not only do you have to pay back the 20% down payment, you also have to share 20% of what your home appreciated. So this is something that you need to understand, work with your lender to see if it's going to work for you. Some people may say, no, I don't want to share any appreciation. But there's going to be some people that this is the only way they can buy a home. So it's worth sharing some appreciation, because when you're renting, you have no appreciation. You're paying for your landlord to gain appreciation. So, give you an example of how shared appreciation works. So, say you bought the home for 500,000. Say in 5 years you decide, okay, I'm going to sell. Say your home is worth now 700,000. So your home appreciated 200,000. So you would just share 20% of that, which is 40,000. So you would pay, you got 100,000 from the down payment, and then you share 40,000. So you would pay back 140,000. But you have more equity from, you made 5 years of payments. When you make a payment, when you pay that interest payment, it's gonna, it goes, or not your interest, your principal payment, then that lowers your mortgage amount. So appreciation, well, equity is what you owe on the property versus what it's worth. That's what your equity is. So you're still getting to keep that equity and some of your appreciation. So it's not like you're getting no equity, no appreciation, but you do have to share some of it. So this is something we want you to be aware of up front, so you can decide if this works for you. And this is what, we do on all of our programs. We want to make sure that you understand everything. We don't want you to say, where's the fine print? We want to tell you what the fine print says. So we're never going to hide anything from you. So you will have to take a second homebuyer education course. So the 8-hour one that I mentioned on the regular programs, you still have to take that one. Plus you have to take a shared appreciation one. That one is free and it's on our website. So, it goes over how shared appreciation loans work. Because again, we want to make sure you understand going in that you are fully aware of what this program entails so you can make the best decision. Because we don't want you to wait and then you get, you go to get the voucher and then you're like, oh, I didn't realize I had to share this. And you may decide this is not going to work for my situation. And again, the lender, when you work with a good lender, and Luz is really good about this, she's gonna, figure out which one works best for you. And she's going to ask the questions. Okay, what are you trying to do when you buy this home? So is it a property that you're like, okay, I'm just going to buy this just for a couple years and then move? Or is this I don't know, but it's probably a property that I'm going to stay in for a while. Then that's where this program may work for you. If you're only going to buy it for a couple years, this probably is not the program for you. But if you're going to stay in the property for a while, then it will work, because there's a max you will ever have to share. So the longer you stay, the more appreciation you get. There will eventually be a cap. So your house will keep appreciating and you still won't have to keep paying, sharing that higher appreciation. So there is a max that you will ever have to share. So that's why it works well for someone who plans to stay in the house for a while. But of course, we can't predict the future. We don't know what we're going to do. But going in, that is just something that you need to think about. Hey, it may work best if I can stay in the home for a little bit longer. But again, the lender will go over all of that with you. So once we announce the date, then you will register for the voucher. And I'll explain that in just a second. Now, the eligibility is a little bit different than our regular programs. So where I mentioned you have to be a first-time homebuyer, you haven't owned own your primary residence in the last 3 years. So still, all borrowers have to meet that first-time homebuyer requirement, but at least one of the borrowers on the loan has to be what's called a first-generation homebuyer. This is where it may disqualify some people. So again, this is why we're coming out early, so you can figure out now if it looks like you're going to qualify. So that way you're not waiting. You could, there may be an option for you to buy a home now, and we don't want you waiting for Dream for All just to find out that you don't qualify. So definition of a first-generation homebuyer is someone who has not owned in the last 7 years. So that means you haven't owned no interest in a home at all. So that means you can't have co-sign for anyone. You can't be on title to any property in the last 7 years. Can't be on a mortgage either. Mortgage, title, anything in the last 7 years. and your parents do not own a property right now. So goes for both of your parents. So if one parent doesn't own, but the other parent owns, then you're not first generation. So both of your parents cannot currently own a home in right now. So they could have owned before, long as they don't own right now. Then you're first generation. Now, if your parents are deceased, then your parents could not have owned a property at the time of their death. So that one's a little bit hard. So, it could be 20 years since, your parents died, but if they owned a home at the time that they died, then you're not first generation. So, again, the lender's going to make sure you meet all of those guidelines. And then one borrower has to be a current California resident. And that could be the same borrower or different one. So if you have two borrowers, so first generation is just one borrower. So say you have two borrowers. Say borrower one is a first-time home buyer, but their parents own, so they're not first generation. But borrower two is a first-time home buyer and a first-generation home buyer because they haven't owned in 7 years, their parents do not own now, then they can both buy together because only one has to be the first-generation home buyer. And then one has to be a current California resident. And that could be the same person as the first-generation home buyer. And then there are lower income limits, and those are on the website now as well. So they are a little bit lower than our regular program. So again, it's the same process. Once the lender qualifies you, they'll be able to look to see if you meet the income limits for Dream for All as well. Now, the documents we're going to need. So again, this is another reason why we're coming out early because we want people to be prepared. So, so you can start, getting documents together if it does look like you're going to apply for the program. So you have to get pre-approved from the lender. So you're going to go to the lender, get pre-approved just like you do any other program. And then we have a special pre-approval letter that the lender has to fill out. They will give you the letter and then you will go into the portal and apply for the program. So you, the borrower, has to apply in the portal for Dream for All. Different than our regular programs, everything is done through the lender. So you still have to go through the lender to get the pre-approval. And then once you get the pre-approval, you're going to have to, once we announce the date, you'll go into the portal, you'll make an account, and then you're going to upload these documents and fill out the information. And that's how you enter into the drawing to be selected. So we need the pre-approval letter. Also, we need a government ID because we need to prove you are who you say you are. So passport, driver's license, state ID, military ID. Also, we're going to need proof of one of you that are applying, if there's multiple, that at least one of you is a current California resident. So say your driver's license has your current address on it here in California, then that kills two birds with one stone. So driver's license will cover your government ID, and then it will also cover proof that you're a California resident. Now, for the first generation homebuyer, if you spent any time in foster care, we automatically consider you first generation. So you would then just have to provide your foster care documentation instead of providing your parents' information. But if you didn't spend time in foster care, then we will need the information of both of your parents. So in the portal, you'll have to fill this information out for both of your parents. Your parents' name, their date of birth, date of death, if that applies, and current address, or their last address at the time of their death. Because we do an investigation to prove that you do meet the first generation homebuyer requirement. So we are going to need your parents' information. We have a third-party investigation company that does this for us. So if you don't have all of the information, so maybe you don't have information on one of your parents, then you will need to provide a birth certificate or adoption papers. So we know not everyone maybe has a copy of their birth certificate. So that way you can start working on that now because sometimes it could take, a month or so to get that, depending on where you were born. Now, if you have both of your parents' information, you put that in correctly, we don't need proof of parent relationship. If we have all the correct information. So we're just learning from last year. A lot of people were leaving this information blank or not the right information. And then when the investigation company did their review, then they're like, oh, we need a birth certificate. And it just kind of held everything up. So we're now asking for it up front. But again, if you have both of your parents' information, then we won't need a birth certificate. We only need that is if you don't have information on one of your parents for that. So you go in there, you upload this documentation, you fill out the information, you submit it, and then it puts you in the drawing. And we don't, it's not a certain amount of time, just depends on how quickly we get through everything and how many people apply. Last year, it took a few months before we did the drawing. But we'll announce the dates that the portal's open. It might only be open a couple weeks. So that's again why we want you to get your information ready. So once we open it, we don't want people waiting to the last minute. You don't have to be the very first person because it's not first come, first serve. It's totally random, but we don't want you to wait to the last minute. That's what happened last year. A lot of people waited to the last minute and then they didn't get it submitted in time. So you want to give the lenders time to be able to fully pre-approve you. We had some people waiting until an hour before the portal closed and was going to lenders trying to get them to fill out the form. Even if you got a lender to do it, they're not supposed to do that. It's really going to hurt you in the long run because if you're not fully approved, even if you get selected, you still have to qualify. So if you don't meet the guidelines, then it doesn't matter if you get selected, you're not going to be able to use the voucher. So do this early so you can make sure that you truly do qualify. So once you apply, once we do the drawing, everyone will be notified. So you'll be notified no matter what. So you'll be either notified, sorry, you didn't get selected, or two, sorry, you didn't get selected, but you got selected for the wait list. And then the one you want, congratulations, you were selected. Here's your voucher. Once you get the voucher, it's good for 90 days. So that way, that gives you that peace of mind when you're out looking for a property that you know you got selected. Unlike the first year, everybody was panicking, trying to find a property so they could get the, funding reserve, and then the money was gone. So this way, ahead of time before you start shopping for a home. So you have the voucher. So that way you're not just rushing into any property. You can take your time and try to find the right property that's going to work for you. So if it is something that you think that you may qualify for and that it may work for you, you can start the process now with the lender. So I know Luz is starting to work with people. All we tell you, and we tell our lenders to make sure to let you guys know, since we don't know a date yet, they can start pre-approving you. But if just say it doesn't open till April, usually your credit approval is only good for 90 days. And so then the lender's going to have to refresh your approval. So you want to make sure if they tell you you're approved right now that you don't change anything. Because again, we don't have a date yet and we don't know. So they can still start pre-approving you just to make sure you're going to meet the guidelines. But just know that depending on the date, you could have to go back and get a reapproval. So if that happens, you just want to make sure if they give you approval today, make sure you don't change anything. Because even if they have to refresh it, it won't hurt anything if you keep everything the same or better. So do not miss a payment. One late payment on a conventional loan could you may not qualify anymore. So you want to be careful with that. Make sure if you have to put in an auto pay, even auto pay can mess up, but just, hey, keep a spreadsheet of all your bills and make sure you're paying them. Cause it could be, one payment. We had this happen last year. Borrower had a really high credit score, good credit. She had a credit card. She paid it off. But sometimes the credit cards, it depends on the statement date, the balance date, and I guess there was some interest that wasn't added. So she just paid off what her balance was then, and then, but I guess it was after the statement date. So then it was only like $3, but she didn't know because she thought she paid it off. And it went a couple months. And so she had a 60-day late, and now she doesn't qualify, where she had perfect credit. Everything was good, but because of a $3 interest charge was enough to make her not qualify. So just make sure, don't go buy a car. Liz will tell you all of this too when you apply with her. So don't go make any big purchases. Don't make any late payments because you want to keep everything the same in case they have to refresh your approval. But when you apply with the lender, usually they're gonna see what you qualify for everything. So look at My Home, Zip, My Access, and then they'll also look at Dream for All because Dream for All is not a guarantee that you're going to get selected. So you at least want to see what would you qualify with My Home or even the city and county program. Because if you're able to find a house now, go for it. Don't wait for Dream for All because there's no guarantee. But if Dream for All is what's going to work for you, then it's worth waiting for. But just know that the lender is usually going to let you know what you qualify, any other programs that you qualify for to figure out if there's, something you can buy with that approval. But definitely the lender will do all of that for you. So you can go on our website and sign up for our e-news notifications. That way you are notified as soon as we announce anything about CalHFA, but especially if when we announce the date for Dream for All. You can go here under Home Buyers, and you can see right here it has a tab here for Dream for All. You can click there, and it will give you that same checklist that I just had on the previous slide. And then at the top of the website, it doesn't show on here, but you'll see a picture of an envelope. That's our e-news. So if you're not already signed up, if you got the notification from CalHFA about today's webinar, then you're already signed up. You may got it directly from Luz, but definitely make sure you are signed up for our notifications. So that way, as soon as we announce something, now Luz is going to keep in touch with all of you and let you know, when we announce something. But that way, you can keep up to date because you're going to start seeing a lot of stuff on social media and some of it may not be accurate. So always go to our website. Our website has our contact information, so you can always call us if you see something and you're like, okay, I don't know if that's true. You can reach out to us and we'll definitely, let you know. But if it's not on our website, it's not true. So we're going to always have the most up-to-date information on the website. So again, I know that was a lot of information, but any questions, Liz, that I can answer?
Let me unmute. Okay, perfect. We do. Let me see. Let me go. There's some, lender questions, which I'm going to help answer as well. And then I'm going to share also my screen. I think one of the questions like, how do I apply? But let's start with some of I think we had this question asked about parents being outside of the country and do they need a birth certificate?
So no, if you're the first generation, we're only looking if your parents own within the United States. So we have no way of checking other countries. So we're only looking at within the United States. The only time we need a birth certificate if you don't have your parents' information. So it doesn't matter whether you were born outside of the country, in the US. We only need a birth certificate if you don't provide us your parents' information.
Mm-hmm. Okay. Another question, and I think this is for more of a lender. One of the questions, can I apply with multiple lenders so I can have multiple entries on the drawing, or does it count as one? No, it only counts as one. You only register once.
Yeah, and it will even tell you when you are registering, you are signing under penalty of perjury that this is correct. And it does say that it's only one per household. So you can't apply because you have to register in the portal. So it'd be a duplicate. It won't let you do it. And if we even if it lets you do it and we see duplicate, could disqualify you from even being entered. We could just disqualify you because you are signing stating that you, under penalty of perjury, everything is correct and that you are applying once and once per household. So
Mhm.
you don't want to do that.
Yeah, yeah. Okay. So another question is, if two people are buying a home together, can they each submit a different application
No,
for the Dream for
no.
All voucher?
So one per household, so one per loan. So if you are buying together, and we had this happen, usually we catch it, but sometimes, things slip through. And this just happened. Three people were buying together. It was a mom and daughter and the daughter's fiance, well, now husband, and they all applied separately. And so they end up buying another house, but they end up getting a voucher, and they wanted to use it. And it's like, no, you can't, you can't do it. So no, only one per household. So if we see that, then you'll be disqualified. You won't be able to use a voucher at all. So
Another question is, I know I need to have some skin in the game. How much should I save before I can even try for a home with CalHFA support?
So this is something Luz can help you out
Yeah.
with because it just really depends on your situation. When you apply, they're going to look at, your income, your debt, all of that, figure out what you qualify for. Luz will tell you you will need some money. Even if our program covers everything for you, you still have to put in what's called an earnest money deposit. So when you put the offer in the home, you do have to put that initial deposit, and that doesn't come from our programs. So you will have to have some money, and Luz will go over all of that with you when you apply.
Yeah. Yeah. And it also depends, right? I mean, there's recommendations of 1 to 2% of initial deposit. However, depending on the market area, how many days has the property been on the market? Is the seller motivated? That 1% may be sufficient. So, we definitely need to have a conversation, in the area you're planning to purchase and also the price point. Another question would be is what is the budget that's projected for 2026 funds? Do we have an idea of how much money are we looking at?
We don't know exactly because part of the funding went to, we gave vouchers to everyone that was on the wait list from last year. So we have to wait until those vouchers expire to know how much we're going to have for next year. So we don't know that yet.
What if I own on a different state outside of California?
If you own in the United States, you won't be first
First time.
generation. Now, for my home, long as you haven't lived in a house that you owned in the last 3 years, we'll still consider you a first time home buyer. But for Dream for All, you can't own anything in the United States in the last 7 years.
Another question is, do you pay the shared appreciation loan only once, or do you have to keep paying an additional 20% all the time in the
No,
house
just
increases value? It's only
Yeah,
once.
just once. So whenever you sell, refi, or 30 years, that's when you'll pay back the 20% plus share 20%. We do allow you to refinance once on the Dream for All without having to pay it back. But when you go to refinance again, then once you pay it back, you pay that loan off, you're done. Then you don't
Yeah,
have to worry about it anymore.
yeah. This question comes up a lot is what if my parents own their homes outside of the US?
It's only within the US. We only have access to check in the United States. So we're not looking at outside the United States. So long as your parents do not own right now in the United States.
Okay. First-time home buyers definition for this program is a borrower that has not owned a property in the last 7 years or not the last 3 years. Question.
So there's two different ones. So if you have two borrowers, one has to be the first time home buyer, so the 3 years, and then one has to be first generation, which is the 7 years, and their parents haven't owned. So just one has to be first generation, but if they're all borrowers still have to be the regular first time home buyer. So the 3 years. So say you have three people buying together. Two of them have to be first time home buyers the 3 years, and one has to be the first generation, the 7 years,
Mhm.
and the parents.
Hmm. Okay. Living parents was excluded from the deed. Deceased parent owned property with two siblings, not by himself. Deed is in the name of living uncles, not my mom. Could I qualify for first generation? But
So it's going to be,
yeah.
did your mom own at the time that she died? So not that it got transferred to your uncle, but if she owned the house at the time of her death, then you are not first generation.
Another very common question that we get is, what if father's documentation is lost and they passed away in a different country and they only have one parent's birth certificate?
So we don't need the parent's birth certificate. We need the borrower's birth certificate.
Yeah.
So if
Mhm.
you don't have information on one of your parents, we need your birth certificate, not your
Correct.
parents. So
Correct.
we need your birth certificate because we need to verify if you don't give us your parents' information, then hopefully it's on your birth certificate because we need to research that to make sure your parents do not own or didn't own at the time of their death.
Yeah, so I think, everyone thinks there's a birth certificate of the parents that needs to be
No,
provided. What we need
no.
is your birth certificate, and then
Hmm.
we need a an affidavit giving us the information of the parents to make sure that they don't own a home.
Right. So yeah, when you go apply in the portal, that's where it's going to have a section where you're going to put in both your parents' information. And if
Hmm.
you don't have their information, that's when you need to provide your birth certificate, not your parents' birth certificate, your birth certificate.
Correct. There's another question that's I think more for the lending. If I wait beyond the 90 days and my income increases, do I qualify for a higher loan amount? So what we've seen happen in the past is that we've issued pre-approval letters and we waited the 30, 60 days for CalHFA to announce the winners. And then during that time, our client's income increased and two things happened. One, it increased so much that they're no longer qualified for the Drain for All program, right? Because there's an income limitation by county. So that was one of the things that there were people were not informed as how much the income limitation is going to be, and if by the time that you're selected, you need to stay under that income limit, right? Another thing that can happen is that if your income does increase and you're still under the income limitation, then yes, you would qualify for more at the time that you get selected. Also, if you eliminate debt during the time that you're waiting, you will also qualify for more. So submitting your application now just gives you an analysis of what you're currently approved for. It doesn't necessarily mean that the time you are selected, that would be your particular scenario because things change, right? Things
Mhm.
change
Yeah.
3, 4 months from now when you're selected. Then your income may be more, your obligation may be less, your credit could have improved. So, you could change your mind about buying a single family versus a condo. So you don't have to stay in a specific scenario right now. You're just getting your pre-approval currently just so you can submit your approval letter to the portal when the time comes. So I think that's always a question that comes.
Yeah.
All
Just
right.
like I was saying that,
Mm-hmm.
if you get pre-approved now and we don't know when the portal's going to open, you need to keep everything the same. That goes for even once you apply.
Mm-hmm.
You need to keep everything the same until you get, select it and find a home. Even if you get a voucher and in between you searching for a home, like Lou said, your income gets too high, then you're not going to qualify for the program. But if, like she mentioned, if you get increased and it's still within the limits, then yeah, that can help increase what you qualify for. So that letter, we're not saying what's on that letter is the only thing you can do. We just want that. We want to make sure that you, at the time of you applying, you are qualified. So
Mm-hmm.
that's all that pre-approval letter is saying, that hey, at this time you meet all the guidelines.
Yeah. Another question is, what if you're buying a land? Will you qualify with this type of loan? And that would be no.
No.
Okay, you don't need any information. What information do you need from our parents? That's a big question.
So that was on the checklist that I just gave.
Mm-hmm.
So let's go back right here. And it's on the website as well. So this is going to be in the portal. So you'll fill out, it'll be a section where you fill this out. So you'll fill out your parent's name, date of birth, date of death, if that applies, and current address. Or if they are deceased, their address at the time of their death. So that's all we need. We don't need their social security number or anything like that. We just need basically names, date of birth. And then that's enough for us to make sure that they don't own a property or they didn't own a property at the time of their death.
Yeah. Another question is when is it going to open up the portal?
Um, like I mentioned, we don't have a date yet.
Okay.
So we will announce as soon as we have a date. But like I mentioned, we just are coming out early, letting people know, hey, it is coming back. So you can start getting ready to even decide if this is the program you want to apply for. We just
Mhm.
don't know yet. So sign up for our e-news. Soon as
Yeah.
we know a date, we will announce it.
Yeah. Another big question is when it comes to the financing portion, people are always asking, should we apply now? Should we wait later? We don't know when the portal is going to open. One of the recommendations we give our clients is we're running a soft pull only, so you're not running a hard inquiry. It's not going to impact your credit. So we are encouraging everyone to submit applications just so we can review what's the maximum amount that you're qualifying for, making sure the credit is correct. If there's any debts that we need to qualify, we also want to make sure we have all the documents, sufficient enough documents to issue the pre-approval letter when the portal opens. We don't want to be running late on any information because once CalHFA announces that program is live and the portal is open, from my last 2 years of experience, it gets a little crazy and lenders get overwhelmed with information. So you don't want to be that person that doesn't get an email returned or you don't know what's happening with your application. So we are encouraging everyone to start submitting the applications. And what we're doing, we're going through conversations with their client as how much you're qualified for. We're providing guidance on not just the Dream for All program, but also the other options that CalHFA has. Because Dream for All program, it's not for everybody, right? It sounds great, the 20%, but note that you do have to share your appreciation when you sell your home, when you refinance. So we're going to be looking at different scenarios as to what would you qualify now without the program? And if you're ready, you can start looking for homes versus what, you would qualify if you are selected for the Dream for All program. So keep in mind, Dream for All programs is a selected program. It's not guaranteed that you're going to receive the 20% assistance. So we are encouraging everyone to start applying now and get that guidance to make sure that you're prepared because sometimes, the credit report agencies that you're using, whether it's Credit Karma, credit.com, it's not giving the proper credit score information. And we just want to make sure that you're ready. So when you're ready to apply, we're all going to be prepared. We will issue you a Dream for All program approval letter. So it's not just a basic any lender pre-approval letter. This is actually going to be on CalHFA's letterhead that you've been approved, and we're going to check off that you qualify based on all the information that Leanne just presented to you. And again, we're going to double check with you, and we're going to ask the questions to make sure that you're eligible for the program. We're going to check your income limits, your debt to income ratio, the credit score. We're also going to give you advice on that you should start already registering for the education course because what we experienced last year and the year before, when the program opens, you couldn't get in a class. You couldn't get the consultation. It gets busy. So we really recommend everyone to start applying. The pre-approval is good for 90 days. And again, keep in mind that we're only doing a soft pull, so it's not impacting your credit. So 90 days go by, even if the portal registration isn't open till March, you're already in our system. All we need to do is just check with you that everything is current. We run another soft pull, and then we're going to issue another pre-approval letter. But then by now, you know everything. It's already collected. You don't have to worry about stressing out that you're not going to meet the portal, deadlines as well. Okay, so that's the voucher. Is the voucher only available for 90 days? That's a big question.
So, yes. Now, I don't know yet if I'm pretty sure it will be the same as it is now. We have been allowing, giving everyone a one-time extension of additional 90 days. Um, I haven't heard that that's going to change, but everything is subject to change. So, I'm just telling you what it is now. It could change, but as of right now, yes, you If you don't find a property within 90 days, you have to do it before the 90 days. You will go into your portal account and then there will be an option to request an extension, a one time. So then you would get an additional 90 days. And then after that, you get no more extension. So if you don't find it in the second 90 days, then you lose the voucher.
Perfect. Um, can you see my presentation,
No, let me
Leanne?
stop. I'm gonna stop
Okay,
so now
perfect.
we can see it. Okay.
Did it work? Can you see it now?
I can see it. Yes.
Yeah, okay, perfect. So, a lot of the questions was, where do we apply? How do we start? You can download our mobile app. You can also visit our website. All the information on the upcoming Dream for All program, it's in our website. We're also getting all the information from CalHFA and uploading there. You can also register to receive newsletters on CalHFA's website as well. But we're going to always keep you up to date. We're going to continually send you messages, letting you know the portal open. I know even this year, a lot of my clients who were in the waiting list, we called them, letting them know if you're in the waiting list, you won, right? They had no idea. So we had to make those calls. So we're going to make sure that you're always informed with all the information. Another question that was asked, do we need to talk to a lender first to apply with CalHFA? Yes, you first need to apply with a lender, with the participating lender with the program. Once you apply with a lender, they're going to issue a pre-approval letter either for My Home or the Dream for All program when the program launches early next year. Okay, I think we answered the majority of them. What is the interest rate for Dream for All program? That's a big one.
It varies. So we have the rate for the people who have the vouchers now on the website, but you know, I wish I could predict the future because I'd be a millionaire by now. But we just don't know what it's going to be for next year. We don't know. So we don't even know what it's going to be tomorrow. So but all our rates are posted on our website. So we're just not going to know until that time comes.
Yeah, and also keep in mind there's a question that a few of our clients or viewers asked is, can I buy a duplex with a Dream for All voucher or My Home program? And the answer is no, only a single family, a condo, a townhome, or a home with an accessory dwelling unit. That is allowed. And we will actually use the ADU's income to help you qualify for more. Okay, but it cannot be used for a duplex. All right. How long do I have to shop for homes once I'm selected with the Dream for All?
Unmute. Yeah, I answered that. So yeah, I'm not sure if the questions came after I answered.
Yeah.
I'll answer
Hmm.
again. 90 days. So the voucher, if you get selected, the voucher's good for 90 days.
Okay. I think income limitation, you kind of, is there an income limitation for Dream for All?
Yes, and those are on the website.
Okay. I think that's it. Most of the questions you already answered. What is the payment period for 20% down payment? When does the repayment will start? And I think you kind of covered that. It's
Yeah,
deferred.
yeah.
Okay. I think that it's it. I think we answered all the questions, but we'll go through all of them once we're off, and I promise to chat with everyone and send the information back. But your next action is to start applying if you are interested in any of the programs that Leanne presented to you, whether it's My Home program or any down payment assistance program as well. We provide various products depending where you are in California. Um, Leanne also covered a little bit about the My Home program and even the SIP program. You can participate with other grants. So if you do want to combine the grants with My Home program, it is acceptable. Also, too, with the Dream for All program, you can invest 5% of your own additional funds as well, and that way you can qualify for a little bit more. Um, it's also too for anyone that's a permanent resident. So ITIN numbers are not or not can't get a pre-approval. Okay, so that's a big question that we get across all the time. Okay, I think we have pretty much covered every question. There's a lot of open ones. A lot of them are kind of the same. So I will stay on and answer the rest of the questions, Leanne. Thank you so
Okay.
much for being here. Any other feedback that you think we can wrap it up with?
No, just apply now. Just see where you are. No matter which program you're interested in, even if you decide, okay, I think I want to wait. We get a lot of people, they're like, oh, my lease isn't up for 6 months or a year. So still, apply now just to see where you are because you may need to work on some things. So you don't want to wait till that year when, right before your lease is up and then you find out that you're not qualified and then now you have to renew your lease. So this is a time to check just to see where you are and then that way you'll know if you'll be ready in 6 months or if there's some things you need to work on, but then that way you will be ready, whenever your lease is up. So just check now. Like
Mhm.
Liz mentioned, she could do a soft pull just to give
Yes.
you an idea of what you qualify for now. Because she may say, "Oh, you qualify for 500,000." You're like, "Well, I need 550." Then you know you need to work on something, either pay down some debt or save up some more money to get a bigger down payment. Because the bigger the down payment, the more it will help you qualify for. So at least okay, in 6 months, I got to try to save up some more money, or pay down some debt, and then that way you'll be ready.
Awesome. Perfect. I will stay on and answer. I think I have about 38 open questions. I think most of them we already covered, but we'll go ahead and reply to them individually. If I did miss somebody's question, or you have a particular scenario, please send me an email. My email address is on the chat. You can also find my information on my website, my calendar. It's updated daily and it's live. So you can, book a 10-minute or 15-minute conversation. If you want to do a Zoom consultation as well, there's, some slots in there for the rest of the week. Our goal is to try to get to everyone. I do have a team that works with me and supports me as your applications come in and gets the process done very quickly for you. So there's no, question that's going to be left unanswered. We promise you to take care of you. We have worked with this program for the last couple of years, and our experience has been that the more our clients are prepared, the smoother the transaction goes. So just keep in touch with us. Sign up for CalHFA's newsletter. That's where all the accurate information comes from. There's also a great Q&A. I don't know if it's still there, Leanne, from the past. A lot of questions that clients had. I think it's
Yeah,
still
we have
someone.
a FAQ section too. Yeah.
Yes, there's a lot of great questions in there. And if there's something that we didn't pick up here, I'm sure it's in there. So it's a lot of great